Micro daily trends. Okay, obviously you guys already know the structure of the market maker trend, the cycle. All right, so what do you mean by micro daily trend? Okay, the market is fractal. Okay, that means it's broken down. Obviously the 1 hour has to show up in the 15 minutes. The 15 minutes has to show up in the 5 minutes, things like that. So it's fractal. And the market makers complete the market maker cycle across all the time frames. All right, so if you think there are only 3 levels on the 1 hour chart, you're wrong. You have 3 levels on the 4 hour chart. You have 3 levels on the daily chart, and so on and so forth. The macro view of the market maker cycle can be seen on the 4 hour chart, which Steve talked about yesterday, the big picture. The mini view can be seen on the 1 hour chart, where we normally like to trade. We like to trade the 1 hour chart, and our entries are usually on the 15-minute chart. And the micro view will be on the 15-minute chart. When I say view, I mean the cycle, the levels, whatever you want to call it. We call it the cycle, so it makes it coincide with what Steve is talking about, the market maker cycle. We also call the micro view of the market maker cycle on the 15-minute chart intraday pushes. Okay, we just distinguish levels from pushes. When I say, oh, I'm in push 2, I know you're talking about a 15-minute chart today. Okay, the market maker does not always do 3 pushes each day, but when they do, and you see your pattern, that is the one you should be focused on. All right, so if you know the pushes, you line up the pushes with the ADR, previous day's high and low, things like that, confluence of events, it'll make your pattern or your entry stronger. All right, so here we go. This is the macro view. Okay, you can see a beautiful peak formation. You can see a beautiful peak formation here. All right, then you see a drop, rise, hit the stops, drop, rise, hit the stops, finally a drop. Now, there are 3 distinct levels, three distinct drops, right? Drop, drop, drop. Okay, and then it sets the new anchor, and it goes away from it. All right, this is pound dollar on the 4 hour chart. So we already know the macro view. This is the mini view. Okay, as you can see, it drops, drop, drop, drop. It sets the little anchor. It comes up 1 level. It does the reset, and then it drops, drop, drop. Usually level 1 is where your challenges are, always. Okay, level 1, as you can see, if it's the trend run, it's kind of either a straightaway or it's going to come quick. Whenever you see level 1 hanging out and you see on a high time frame the moving average just crossed, look back to the 4 hour chart and you're going to realize you're only in level 2. All right, so that's what I mean by watching the high time frames and things move fractally. So this chart, 3 levels of drop, is the same as this chart. You have 3 levels of drop, 1 level of rise, and 3 levels of drop. Okay, that's what it means. Here is the micro view. In the micro view, obviously we saw some of that yesterday using the days of rise, days of drop. Okay, here's your anchor, peak formation, your pattern, and then we're looking at patterns. Now, what the micro view pretty much we're looking at is you pick one section of it or one day of it and you're looking for 3 levels of drop. So over here, for example, you're going to see, okay, here's my little pattern. It comes down, consolidates, it drops, it consolidates, it drops one more time, and then it ends the day down here somewhere. All right. So we're going to focus on the micro view. I was just showing you the patterns as it rolls. Okay, so the microcycle played out intraday. All right, the market makers move the intraday cycle with 3 pushes, just like they do 3 levels on the higher time frame. Each push is approximately ADR divided by 3. Okay, that's what Steve said. It's 3 drops and then ADR divided by 3. The pullbacks are usually 25 to 50 pips. All right, so it pulled back 25 to 50 pips. You have to measure it to know whether the pullback is valid or not, because sometimes they just go sideways consolidation in a 10-15 pip channel, and that's not really pulling it back. So you have to watch for these pullbacks. You have to measure them. All right, you can trade the pushes once you identify the high of day or low of day, and you got to know the market maker trend direction. You have to know which direction the market makers are going. Okay, if you try to trade the pushes, I'll show you an example where if you're not in line with the trend, and even if you have the pattern, you still cannot take those trades because they're not clear. Okay? Each push is easy to identify as they usually bounce or trap to a moving average. All right, normally they'll bounce off the moving averages. They will show a pattern. Either what? You have 3 identifiable patterns. You have your railroad tracks. You have your quarter wood. And you have your star pattern. Okay, so pretty much all you're looking for are these 3 patterns. Simple, 3 patterns. You don't have to worry about all this other stuff, little candle, this, that, nothing. If you can name the pattern, you can take the trade. Okay? You got to wait for the rejection of price before entering your trade. You do not anticipate the trade because you have no idea if it's going to bounce or go lower. Or you have to wait for rejection of price. And once price is rejected, you should be able to have a nameable pattern. Okay? If you have a nameable pattern and you took the trade and the trade failed, which I'll show you an example of, you still did what you're supposed to do. You're supposed to trade a setup. You're not supposed to make stuff up. All right? So here we go. You identify the pattern to set up your anchor. Okay, I got my anchor. Down, railroad tracks, I'm in. That is my anchor. Okay, now you can trade the pushes. Where is my first push? Well, here is my first push. Price broke out of, this is my 1, 2, 3 pattern, right? Here's the W, for those who can't see. All right, the 1, 2, 3 pattern, and it took out 2. That's why I drew the box right over here, right? Took out 2, induced short by closing below the moving average, and then this is your nameable pattern, railroad tracks. Your entry is right after the railroad tracks. Okay, that's your push 1. This is your push 2. It came up. It took out this zone. This one took out this zone, right? This one took out that zone. Comes up, start consolidating. It induced short by throwing this needle over here. They do it all the time, by the way. They do this kind of stuff. They induce. They close below the 50. People go short here. At one point, this was red, like this. Terrible drawing, by the way. This was red. They induce short. People go short. The nameable pattern right here confirms that the market makers are going long. So they induce. This is called a trap. Your entry is right there going long. Okay, and then you just hang on to the trade until it hits your target. Don't go short here. Why? There's nothing there to the left. Is that a first? There's nothing there. It's not nothing. Your trap, the volume trap is up here, the blue tracer. So don't fall for this stuff. Don't fall for this stuff. There's nothing there. All right, it's just an inverted hammer. That's it. What does that mean? It means absolutely nothing. It means it's trying to get you to get excited to get out of a trade and not give you a move from here to here, which is almost the same distance if you measure the move from here to here, almost. Okay, so they tricked you. And then this is your peak. Now, some people, this is how we used to do it when Steve first showed us. We used to draw these little dashes as pushes, like that. We draw these dashes like this. Okay, and we call them pushes. Some people can't see that. Some people like to see it this way. So first thing, as you can see, the market makers came out of the zone, false move to the downside. And then you get 3 pushes or 3 intraday rise. So from the second leg, this is push 1, pull back, push 2, pull back. This is push 3, all the way up here. At the end of the day, they pull back into consolidation, start to cycle again the next day. It's exactly what Steve has taught us. You can trade these. You can say, you know what, if I can't name the second leg and if it doesn't bounce off a moving average, I am not going to take it. If I don't see a trap of the moving average, I'm not going to take it. I'm not going to start being worried about, oh, look at these pins. No, where is my anchor? Once I know my anchor, intraday, this is what I'm expecting. Does it always do it? No. But you're going to know when it doesn't do it. Okay, I'll talk about that. Some more examples. So here we go. It came up, vector first leg, came down, came back up, second leg railroad track. You're in. It's not going sideways. You're like, you know what, 2 hours passed, looks like it's not really moving. You kill the trade. It's okay. It's all good. Okay, I know these boxes are all messed up. This is an older version of the boxes. Price came back up, challenged to high, and it came down. So now this structure right here looks like an M, right? Here we go. So you draw your M. This is my 1, 2, 3. Here's my M for those who cannot see it. Okay, this is 3 hits to the high, obviously. There's one hit over here. So you got 1, 2, 3 hits to the high, right? But that's your M. So when you wake up, you're right here. You wake up right here and you look out to the left and you say, there's an old saying, they always say, look left to be right. Okay, look left to be right. So if you look left and you see, I see 3 hits to the high. I think that's the reset. I'm going to see what entries I can get to go short. Obviously, there were no long entries, right? You don't see a W over here. Right? It's just kind of bouncing off this moving average. All right. Let me clear the board. Okay. All right. So I come in, I'm looking at the chart, I'm looking for reason to short this pair. Why? I'm seeing 3 hits to the high. Some people call it shoulder, head, shoulder, crooked. Okay, the neckline is like this, crooked. Right? Just draw the neckline like that. But anyway, you see that? Now the way I like to do it is I like price to close below my number 2. Okay? Because if this is my M structure, once it takes out the middle part of the M, that's when I begin to count my pushes. Alright? So this would be my push 1. And this would be my push 2. I put the pullbacks in because I know the pullbacks are very, very important. If it's just stuttering around here and it drops from here, it was all part of this. It's all part of this, and this would be my push 1. You see what I'm saying? So the pullback is vital after they close below. The pullback was 32 pips. Only issue with this was if this one kind of closed here, that's the entry. But because it's closed so far away, because from here to here is already 32 pips, this is probably 50 pips. So forget it. There's no entry. Okay? From this low to this high was 51 pips. It pulled back 51 pips. I'm happy. Notice to the left. Look left to be right. When they closed, now I already know this is my peak structure. Okay? Where's my trap volume? Right here, the blue tracer, and right here, the blue tracer. That's where the volumes are trapped. They trap and they rose from there, right? That's why this is the low of the day and you have the high of the day. That's where the volume is trapped. Okay? So what the market makers do is they do these pullbacks. If you look to the left and if you see no trap volume, volume is not trapped, volume is rising right here, right? Price is just rising. There is no trap volume. If you look to the left and if you notice no trap volume, and if you see a pullback of 25 to 50 pips, like Steve says, you look for a nameable pattern. So here's your evening star pattern. Your entry is right there. And that's your move to the downside. And you can hang on to it. Price did not close above the 13 EMA. You just hang on to the price. And it keeps going, by the way. It just keeps going. I just stopped it at the blue, the day tracer. Alright? So, because this is my anchor, I know I'm looking for 3 days of drop or something of that sort, right? 3 levels of drop. So, can you take these kind of trades? Yep, these are called pushes. You can trade the pushes as long as you're trading in line with the market maker cycle. Okay? They're just mini levels played out intraday. Okay. Pushes can also happen between 2 days. This is one of Oslim's favorite thing to do. She'll see the W and she start counting it. Remember, it has to take out 1, 2, 3. Gotta take out 2. It took out 2. This is my push 1. As you can see, it goes into sideways consolidation. It gives me a cow, but I'm sleeping, so I couldn't eat it. Here would have been your entry. Why? Where's my next resistance level? Where do you think price is going to bounce next? Here, and here, and here, at the bottom here, where they finished the last trap move. Okay? So once I see this, and price closes above the 250 and did a stop hunt, or trap move to the 50 EMA, I close above the 13, I'm in. I understand what the market makers have just done. They've induced by closing below the 50, and they trapped with this move, the shift bar. They finished the trap, and then they really shifted the zone after that. Okay? You could have entered on this one, on the bounce of the 13, but your 2 hours, you wouldn't have lost. That's the key, is not to lose. So if this is 1, 2, 3, 4, 5, 6, 7, 8, you'd have closed your position right here on the doji. Alright? A couple of pips. Timing is off. It's a little late in the day, but that's my push 1. Okay? Price never took out that high. You see? There's a sideways consolidation. They finished the trap. They started moving. This one did not even touch the moving averages, so I don't count it. This is the next level of consolidation. So that's my push 2. Push 2 consolidation, push 3. So pushes can happen between 2 days. Doesn't always have to happen within 1 day. So if you see this M and you look to the left, and you're like, I see 3 pushes. I like this M. I'm going to take this M. And it pays out because this is 32 pips. And if you entered in above it and you got out below it, you hit your 50. Did it straight away out of here. Okay? If it doesn't hit the moving averages, there is no way you can enter this trade. No way. It's very tough. Again, you find the anchor pattern and your pushes begins there. Okay, so I found my anchor. It took out number 2, 1, 2, 3. It's my first move down. Here's all my consolidation. This is my next move down. Right? I don't want to get ahead of myself. So that's 1. Notice it did railroad tracks. It came up. It did railroad tracks. You took 1, 2, 3, 4, 5, 6, 7, 8. You killed your trade right here. You got in right here. Maybe a scratch. Maybe -2. Maybe minus spread. Okay? Why? You're trading in line with the trend, the market maker trend. Not the retail trend, the market maker trend. That's why even if you're wrong and the market makers wanted to hit the stop one more time before they pull away, you will still not lose money. So let's say you said, that looks like an M. Here's my first leg, railroad tracks. It comes back. And then here's some sort of a non-nameable pattern, but it closed below 13. Take another position. Okay? So if they give you an M, you restart the clock, the 2 hours clock. And sure enough, give you profit. Right? It did a pullback again. Now you have a nameable pattern. This is not close enough. It didn't even tap it. Okay? It came close to it. I don't like when it's close to it because it does things like this. And make it look like it's going to drop and then it goes above it. And your stop is right here and they'll kill it. Okay? If you're trading pushes, and if it gets close enough, wait for the moving averages. Otherwise, you pass on the trade. They always hunt like this. They usually go above, or they'll do like this railroad track, the 2 pins, but kind of very close to the high. You saw the last couple of pictures I've shown you. Okay, they'll induce long. Just through a star pattern. They close right back inside, you take. Okay, so for those who doesn't like my drawings like this with the pushes, I did it the other way. Here's your M pattern, vector first leg, close below, come back above, here's your M, right? This is level 3, this is an M pattern, right? Second leg of an M, level 3 becomes level 1, push 1, level 1 drop, level 1 consolidation, level 2 drop, or push 2 consolidation, push 3. So hopefully you guys can see the pushes, right? It's pretty self-explanatory. I always go from the highest point to the lowest point. Always highest to the lowest before they pull back, highest to the lowest before they pull back. Okay? And all you're looking for is trading in line with the market maker trend. You watch them trap, come back in. You watch them trap, come back in. This one did not trap, right? Even though it's a railroad track, this is nicer. But they induced and they trapped. Okay? The traps are nicer than the stop hunt. This is a stop hunt. They just threw a needle above it and they pulled it away. Okay, so I call this another way to see the pushes. Okay, more examples of intraday pushes. You see the blue tracers, the big fat W. They threw a quarter wood. That's my anchor, my multi-day anchor. Okay, it came above. So once it finishes the anchor, it came above, it pulled back, it did railroad tracks. This one did not close above the 50. I passed on this move. I'm very particular about what I like to see. It come up again, it takes up this high, it pulls back, it also does railroad tracks, it also hits the water, and it closes right above the 200 I'm in. Why? The 800 is right here, my resistance. Price is now broken through all the resistance. Where do you think it's going to go? There's the blue tracer right here. That's where it's going to go. Alright? They did the same move. They induced, they trapped, and they came right back inside the range. Alright? So, you gotta wait for these traps. You can go in after the trap, but you have to understand that they can sometimes extend it if there's another trap closer. Like, for example, this was yesterday's low, right? There was no nameable pattern. It was not a trap. It was a whole bunch of little candles, garbage. Why? Because they saw the previous day's peak low right there, maybe low of week. They came down, they induced by closing below this low, right? And they set the anchor. And now once you know, okay, now they trapped. Now my anchor is set. I'm going to trade my pushes. Cool, I got it. You came up here, you took this first move. It pulled away. It pulled back. It did the railroad track. Oh, I didn't like it. I'm not going to pass. I'm going to pass on that. You're waiting for the third move. I mean, the second push. And when this one closed above, you're gangbusters. You get in there. And now you can move your stop once you're from here, right here, once this thing is up here somewhere. Okay, so this one is in positive. Price is up here. Taking out this high. You move your stop loss from here, right up here. Choke it up, choke it up, choke it up. As price comes up to the high, you kill the whole trade right up here. Okay? Okay. Pushes can happen late in the session as well. This is EJ, just a couple of days ago, last week. Beautiful pattern. You enter, you take your trade. Beautiful drop. This is only one drop. Okay, it formed a nice W pattern. Take it again, going long. You better get out at these moving averages. Why? As you can see, the moving averages are very close together. You can see them all fanned out here. Directional bias is short. I'm looking for shorts, so you better get out of the moving averages, remember? If you're going counter, water, male, obviously blueberry was here first. So you get out of the blueberry, and this is your first pullback, and it gave you a star pattern. You take again, like a evening star. Okay. See, then it took up, then, okay, hold on. Whoops. Then you can see it took up this low. Or you can say this low, whatever you want to say. It took this out. This is your second push. Alright. Now, notice it says stop loss was 30 pips. They're pretty big, these candles. But if you entered here, your stop, if you entered here, your stop has to be above this, right? It's pretty big. You say, you know what, 30 plus pips, I don't like it. I only like 23 pips. You wait for it to retrace 50% of the railroad track, and you take it. If it hits your 13 EMA, that's even better. Okay, and then it drops another 40 pips from there. All right, US session, you're looking for anywhere from 30 to 50 pips, whatever you're comfortable with. All right, they don't usually run like London. Push one can challenge the high, or challenge the pattern or the peak. Okay, so this is my vector coming up, forming my M pattern, right? Here's my nameable structure. I go. It drops 26 pips, usually 25 pips. I say, okay, if it comes back against me, I take a scratch, +1. And guess what they do? Here's my Asian low, right? Notice this white tracer right here. They induce the breakout traders. They hang out. The market makers trap by coming and closing inside the Asian range. This is called a 3-candle reversal pattern. Most people call it morning star. Okay, price rises from here. It rises 48 pips. So even if you got out, so you got in here and you got out here, it's 48 pips. But if you got in here and you got out here, that's about 30 pips, roughly. Okay, here's 20, 22. Here's at least another 8 pips. About 30, 29, 30 pips. Okay? You would have taken a scratch again. But notice, if you're watching the hard right edge and this is not there, induce, trap, you go. Right there. That's your entry. Okay? Notice this push one exceeded the pattern. Why? There must have been people that had the money trap. You know, they put the stops here. There's a lot of money trapped there. And market makers were like, you know what? Let's induce short, come up, hit these guys, induce long, and then drop it. They know they were going to drop it. Okay? They drop. They pull back. Now, again, if these candles were not there, this one coming back in as a trap, I would have gone in here on this move. That's my morning star pattern. Of course, if it gave me a railroad track, go again. That's the move. All right. End of day, they trap back in here. You take. If it gives you a reversal, this is a reversal pattern, right? Looks like it's going to drop. You get out. And it gives you a railroad track. You take again. So this is understanding the pattern, the structure, and what you want to do. How the market makers are manipulating the market. How they're moving price. Trapping volume. Inducing. And money grab. Alright, I like this because it came right back inside previous day's high. Alright. Okay. Next. Alright, so here we go. Sometimes there can be only 2 pushes. Alright. Beautiful structure. I'm in a long trend. How do I know? My 50 is above the 200. I'm looking for longs. It comes out of this consolidation zone. 3 swipes, 1, 2, 3 to the low. Induce, induce again. There's divergence. The W, railroad track to in. So now you're all happy. You're like, cool, I got in. You hit your target. How do I know? This is 82 pips. I already hit my target somewhere in here. Now you're like, all right, cool. I'm only in push 1. I'm looking for longs. I'm going to wait for them to pull back and let me get in again. All right. So they pull back. Should have measured this. I didn't. Probably what? If it's 82, this is what? Half. 40 odd pips. They pull back 40 odd pips, maybe 50 pips. You're not going to anticipate the move and get in long here. You don't know whether they're going to come in here and throw railroad tracks all the way down to the right here. You don't know that. So you wait until they give you a nameable pattern. Don't guess. It comes in, it closes right above the 800, 200, 1350, everything. Your entry is right there. If it's too big, you wait for the 50% retrace into this candle and take it. All right, so this is only push 1. Now you're looking for push 2. You start seeing this stuff. You're like, not really bouncing off anything. I don't really see anything. Okay, done. All right. Okay. Pushes are not clear when you are counter trend to the market maker cycle. How do I know that? Here's my moving averages. 250. I see a beautiful M pattern. Second leg, quarter wood. I'm short. Price closes below the moving averages. Hit the stops. Continue to drop. And then I'm like, okay, it's going to come up, hit the stops, and drop one more time. It doesn't. So you get only push 1. And then your second push doesn't really work. Why? Your counter. The bias is to the long side. The market maker trend is to the long side. You're taking a counter trend trade. That's why you don't get 3 pushes. Okay? So you get push 1. You get push 2. You get only 2 pushes. There is no third push. All right? Okay, so I'm going to end with this one. This is from my buddy Jim Nicholson. Homework is the authority. You have to sit down, look at it, absorb it, understand it. It's always the best if you find your anchor intraday and look for 3 pushes. 1. This is not the right answer. Some of them are clear like this. Some of them are not. Okay? This is nice. Off the peak formation, you're looking for 3 clear pushes. 1, 2, and then 3. It should end the day back into consolidation. All right? So, hopefully that helped. Okay, I didn't get a chance to put together some trades and show you guys. I do take these push trades, but I didn't get a chance to do it. Didn't have enough time to do it. All right, so now I'm going to open it up to questions, and I'm going to see what you guys have any questions, or what do you guys think, and what's going on. All right, let's see. Now there's a whole bunch of questions here. All right, just hold off on asking another question for another couple of minutes. Let me just start from when we first started. Okay. Ian asking, what is the rejection of price? Rejection of price is when they finish the trap move. For example, it'll be right here. You wait for the inducement and then the trap. rejection of price at this level. All right. Don't anticipate the rejection of price. Wait till it does reject, then you take the trade. All right. What is the good rule of thumb when the second leg approaches the high? Because many times I don't enter because the price turns short before reaching the high, although within 5 pips. What if it's 12 pips? Okay. Remember Nelson was always saying, if you see a reversal pattern or any pattern, let's say I see an M and then all of a sudden I see a W over here, I'm going to get out of my M position. Okay, so if this one closes above, comes back in, closes above, I'm going to kill my trade. Why? I can always get into a trade. If it turns around like this and comes back in, I can get back in, right? But if price closes up here, I'm going to kill my trade. All right, it did not do what I thought it was going to do. Obviously, I know this is an M, and this only push 1. I'm waiting for push 2 and push 3. But if I see a beautiful fat W, it goes 1 session and 1 leg, and the second session into New York, and I see an M up here, I'm going to kill this trade, waiting for it to show me something else that is going to resume to the downside. Then I will get back in. All right. A larger pointer would help. This pointer is the biggest I could find. It's a pretty big pointer. What do you mean by trap volume? Trap volume is, whoops, hold on. Okay, so trap volume is when volume is like they trap, like here. You see the previous days, that's where the last rejection, right? That was the high at some point. Price rejected off there. There's certain amount of volume. The market makers did a money grab up here somewhere. Okay, they could have been something like that. They grabbed some money up here and they pulled it away. That's why this blue tracer tells you where the last trap was done. Usually, ideally, second legs. Right? Maybe first leg, sometimes second leg, depending on which one is lower. So I know there's some trap volume over here. You see? The blue tracer. Volume is trapped. Okay, this tracer, price is still dropping from here. So just because the day started here, that doesn't mean that the volume is trapped here. Usually the volume is trapped on these patterns. This is where the volume is trapped. Okay? This is the pullback for them to book profits, a little bit of it, they pull it up. They pull it back, book a little bit, pull it up. That's what they do. But the majority of the volume is trapped on the anchor. Wherever the anchor is, that's where the volume is trapped. Okay? What about not trading back to the peak formation high? Yeah, you do not trade back towards the peak formation high. So if this is my peak, I'm not looking for shorts here. I'm not looking for it to go, I'm going to take this breakout to the downside. I want to trade away from this. All right, that's why the resets are a little bit hard, because usually it's level 1 of the peak formation low. All right, so, but you will be able to see that big fat multi-day M pattern, and then you'll be like, oh, I see it. So let me see if there's any resets around here. Like this. This was a reset, right? Price was dropping. As you can see, the 800 is up here, the 200 is down here. So obviously price has been dropping, right? They pull back 1 level, and they did 3 hits to the high. That tells me price is going to drop. It's a reversal pattern. It's an anchor. So it sets the anchor and starts dropping. Okay, Tom says, I vote for drawing the pushes lines in the direction of the push rather than the opposite direction. Absolutely, whatever helps you to see the pushes. Okay, this is from Horace. For guys like me who get burned at the micro level, I guess it might be a good idea to study the macro level before delving deeper into the micro, which is more advanced form of trading. Yes, the micro level is the more advanced form of trading. Can you take more trades this way? Absolutely you can. You're taking 1 trade here. If this bounce, if it just closed right here, you've taken it. and this one closed again, you've taken it. So you've taken 3-4 trades in one trend run in that one day, compared to the way Steve and a couple of other people trade. They only trade anchor level 3s, and they just go here, and then they'll go here off the high, and then they'll hold the cycle. Like Dave Jiang, he'll hold it for like 2 days. That's a different style of trading. Okay, some people like to trade that way. Okay, on pullbacks, do you always look for the candle to touch the water? Not always. Sometimes when price is accelerating very far, it'll bounce off the 13, but it's a little bit hard to see. So you see, let's say this is push 1, and price is pulling away pretty fast, pretty far, pretty furious. It'll come back, it'll pull back into the 13 or through railroad tracks, or 2 pins to the 13 and start dropping. That's the very advanced way of trading. Can you do that? Yes. But why don't you just do this first? Do it for 6 months, and when you're successful doing this, and you're homeworking the bounce of the 13 at the same time, then take that. Alright? Do we show that in the DMR? Yes. Can everybody and anybody that hasn't been successful trading a big M or big W pattern trade that? No. Why? Because if Steve tells you and he shows you his trading book of trades that he's taken, 5,000 of them, that is profitable, and if you can't do that yet, then you have no business trading off the, off the 5 EMA. And I've seen people ask me about the 5 EMA, and then people ask me what about the 13 EMA on the 5-minute chart, all that stuff. Just, if you tell me, and if you show me, and if you say, listen, I get M's and W's 90% of the time, I'm like, absolutely, go do it. Alright? Because, like Steve says, at some point, trading is supposed to be boring. And it didn't hit me for a while. I'm like, what do you mean trading is boring? Trading is exciting. Are you kidding? No. If you have your signature trade and your secondary trade, and you know how to trade the pushes, and if you're not trading the pushes, if you're just trading the big patterns, and you're sitting and waiting for the pattern to present, it could take 2 days. It could take 3 days for the cycle to end, and then you take the trade. Yeah, it could be boring. Okay, so everybody knows this is in here. It's under announcements. Okay, so if it's in the Market Maker Forex, if you go straight into announcements, it's right in here. Okay, curriculum. Daily market review, Monday to Thursday. It doesn't say Sunday. Monday to Thursday. And the curriculum. Okay, so you can just read that. Pretty simple. And this is the curriculum laid out for you by weeks, what we're going to do. Next season, which is when we do it the next time, I'm going to tweak this a little bit. And the way I'm presenting right now with PowerPoint, that's how I'm going to do it moving forward. All the presentations. And we'll tweak it a little bit, okay? Make it a little bit more even more robust and more simplify it a little bit. So we finished levels, and this week I got a fantastic presentation on entry candles, and Casey's going to be our guest presenter Tuesday, which is tomorrow, and I'll do this entry candle on Wednesday. All right, then the following week, Jim is diving into a little bit deeper into the high-low drill. All right, how he sees it, how he does it. And then we have the Brinks and Safe Trade. Hopefully we may have a guest presenter on that one too. Swing trading. We also have a guest presenter for swing trading. All right, counter trends. Trade management and position sizing. We're going to have a guest presenter on that one. TDI, signature trade. Maybe we'll have a guest presenter on that one too. So a lot of good stuff. Okay, everything that is, necessary for you to understand the whole educational piece of it is broken down individually with presentations like you just saw the one today. And of course, here's the PayPal link. Okay, so a couple of quick emails. What I was sent. This is my buddy David. He's been sending me his accountability stuff. I mean, he's pretty awesome. Last week, 6 winners, 1 loser. And the 1 loser he took was in the Asian session. He tried to go short in level 3, and the market makers extended the high. Okay? All the others hit 30 pips, 50 pips out of level 3 short. And he was doing that based out of fractional disparity when he took EU and dollar Swiss. Okay? And then he writes why and what happened. I prefer to take trades at London Open or the US session, but sometimes I notice in homework level 3 will happen in Asia and won't come back. So he took the trade and lost. And it was a second leg confirmed pattern. So it's okay. Nobody said you're going to be 100%. Okay. I missed at least a couple of great other setups because I overslept London. And you have to wake up. And he works 9 to 6. He does have a business. He runs a business. He trades. He has a bunch of kids. That's fantastic. Okay. So this is what we call the accountability factor, and people do that. So now when you're sending us the trades, you're not going to be taking all kinds of trades. You're like, oh, that looks like it's bouncing off the 5 moving average and things like that. You're going to wait for the right setups. All right. Somebody said I was boring. So somebody thought you were boring. I soaked it up like a sponge. I went 11 straight trades with no scratches, pocketing $1,600 this week until this afternoon. It was trading in the afternoon. I thought it was a good W in the euro and got burned on both of them. Okay. 1 to the pip because I was trading euro FX futures. You definitely straightened me out on why I should not have even thought about taking those trades. So we help you. That's what we're here for. He sent me his trade. He said, well, why do you think I lost? And I'm like, it's 2 o'clock in the afternoon. What are you trading? All right. Here's another one. Those A1s, A2 trades identical to what I've observed and used to trade in the past with the exceptions of the market maker pattern. And that was a real game changer. We talked about this in the presentations when we were doing A's and B's. And it was a game changer for him. He's beginning to get it. He's beginning to see it. All right. So anyway, that's another David's email. So for presentations this week, there were a lot of very good emails, and very proud of the guys that are doing a fantastic job in the DMR. They've been putting in the time to make sure they give a very good product. So if you guys are still struggling, and some of you guys need some help, we're absolutely here to help you guys out. Okay? How many candles are needed to form the bottom of an M or top of a W? Steve says an M or a W should be minimum 9 candles, right? 30 to 90 minutes. So there is no such thing as a minimum, because if it's a multi-day or a multi-session M or W, it could be 20, 30 candles. I don't know. Okay, Kim has spoken of taking 2 pins to the moving average at the top of a push. Do you consider it a valid pattern? Yes, Steve calls it 2 pins to the water. It look like railroad tracks, or look like a star pattern, or something like that. Okay, those are good. You can take them. They're 2 pins to the water, 2 pins to the mayo. That's one of the things Steve does teach. Yes. Sometimes they don't always trap. This is a trap, right? They'll induce, they'll hang out, they'll trap, they'll come right back into the trap. Sometimes they'll just bounce like this. You see, they'll throw 2 pins like that. Not like this, but I'm just saying when they pull back, they'll throw 2 pins and then they'll take off. Okay? For anticipating the straightaways, it is okay to take the trade off the EMAs. I don't trade the straightaways if I don't see them hunt the stops. Remember, Steve says you gotta wait for the stop on some song he was talking about yesterday. You gotta remember that song. I don't know what it is, but anyway, he says you gotta wait for the stop hunt. So if it does a straightaway with no stop hunt, it's a pass. It's okay. Like this. This is a straightaway, right? How are you gonna get into this trade? How do you know it's not gonna come down here and hit the stop before it moves up? You don't. Okay, so if price is hanging, dancing above the 13, and if it doesn't do a nice pullback to the 13, you pass on the trade. If you see a nice pullback, you can take it. All right, like Kim says, a little advanced. If it price moves up very far away from the 13, right? If the price is up here and then pulls back to the 13 and throws these two pins, take it. You can take it. Just make sure you're not in push 3. It's going to form an M right up here. Make sure it's, it's push 2 pins. Sometimes when price accelerates and they pull back, they'll bounce off the 13. So the way they bounce is they normally bounce off the 200 first, then the 50, then the 13. That's what they normally do. Go. Hold on. I'm trying to show you a good example here. See, like this. It'll form the pattern. The 200 is above, right? If the 200 is below, it's bouncing off the 200. Let's say if this is the 200 right here. It'll bounce off the 200, bounce off the 50, bounce off the 13. That's how they bounce. They take each moving average higher and they bounce off it. So they go 50, 13, and then they'll form the M pattern, they'll drop. So that's the best one is when the 200 is right here. 200, 50, 13, continue up. One view of pushes slanted white lines is of mini trends in market maker direction. And the other one is of the mini pullback to the market maker direction. Yeah, I was just trying to show. Some people like it seeing like this, the push, consolidation, push, consolidation, push. The counter, we were just drawing these before because it's easier to, it's easier to see the consolidation, right? So we just kind of draw a line to the consolidation. That's what it was. Okay, if you are staying in for a day, part of linger term trading, you just stay in for all the pushes and pullbacks, correct? Yes, if you're trading for the day, every time it pulls back, Steve used to call them back wave. Some of you guys remember, it's called J hooks. All right, every time it does the J hook, it'll hook and then it'll pull away and you move your stop from here right to below the hook. It'll pull back, it'll hook, it'll start taking off. Price is up here somewhere, you'll move your stop from here. He used to call these jumping stops. He'll jump the stops from the here to here. Okay, so these are J hooks, and it's almost like each rise consolidation, rise consolidation. It's the same thing as the levels. All right. Please show how you come up with the trap volume line. I just draw them. I just go in there and I use my little trend line, and I draw the trend line, and then I double click on the trend line. I right click on it, trend line property, then I change it to the dashes. I draw it. Okay, Jerry's asking, I notice you do not use the crossover arrows to help indicate direction. Why not? A very good question. There is a way of using the crossover arrows, and Steve used to have them when we were trading, when he used to teach us way back when. We were using the crossover arrows to confirm the lock of the pattern. So after the second leg has formed, and when the moving average crosses, the 513 moving average crosses, and the arrow fires, we know for sure that the pattern has locked. The M or W pattern has locked. Then all we're doing is if we are a little late and we see a shift bar, all we do is wait for price to retrace back towards the moving average, usually the 13 EMA or 50% retrace of the shift bar. So that's what we're using the crossover arrow for. All right, because sometimes we could not see, when we first started, we could not see the M's and W's cleanly. So we were using the crossover arrows. So once that arrow fires, we would look and see what's going on. As a matter of fact, talking about entries, when I do a presentation on Wednesday, we're going to be talking a little bit about how to use that for those people who can't see M's and W's cleanly. Okay, that could help some people. Okay, so if people are being confused with being able to distinguish the difference between trap moves, collecting pending orders, and stop hunts, Does the reason really matter? Franco, the answer is no, the reason really doesn't matter, because all it is they went there to grab money. That's all it is. A stop hunt is the same thing, but not really as a trap move. A stop hunt is, let's say you were correct. You saw an M pattern, you took the short, okay? So let's say you saw this move right here. You said, you know what, I see a beautiful hard right edge, right? So none of this has happened yet. So you saw this and you went in right here, okay? This pin bar coming down, they widen the spread. That's the stop hunt move. They hunt the stops of those people who got the correct directional move. You got the move, your stop was too tight, they came in here, they widened the spread, they took your stop out. That's the stop hunt. A trap move is when they induce you to go in one direction, they hang out, people pile in to go short, and then when they come right back against you, that's the trap. They have to induce first to do the trap. They cannot do a trap on pin bars. So hopefully that made sense. They will have to close below here, and people say, oh, it closed below the 50. Let me go short. The direction is short, right? When they come back, only when this green candle closes is the trap complete. When it's hanging out here, there is no trap. When this one comes back, now you're negative 20 pips, that's the trap. Now you're stuck. Okay? Has there been a reset in many of the pairs in the last day or two? Yes, Stephen, that is correct. There were resets. If you look at the 4-hour chart, you'll be able to see it. Would this screen be a 22-inch? Yeah, the screen I'm actually presenting on is a smaller screen than the one I actually trade off of. I have a 27-inch screens. Okay, you've told us before not to trade between all the moving averages or just the 50, 200. Can you explain a little more? Yes. A pretty good example actually is, you see how price kind of bounces back and forth over here? Between the moving averages, price is going to bounce back and forth. I like my M's and W's, my anchor, to be below or above the moving average. I don't try to take the moves inside the moving averages. And actually the reason is right here. It's kind of clear. You see how price moves away from it, bounces, and then moves away from it? It's cool. Why? There's a nice distance between the moving averages. That's why you can trade that. If it's very tight, if the 200 is right here in between, okay, so let's presume that the 200 is right here, I would not be interested in shorting this, because the distance from here to here, if it's like 12 or 15 pips, that's not good. Why? Because my stop is 12 or 15 pips. All right, I usually like 2 to 1. So if I take this trade here and my stop is about 13 pips, I'm looking for minimum move 26 pips. I would prefer at least 30 pips just in case it pulled back. Okay. Can you define strips real quick for me and tell me where to learn more about them? I don't know if we're going to do a session, one of these sessions on strips and indicators and stuff, but send Steve an email. Maybe we can do a session on it. Or we'll have Ray do a session on it. How about that? Since you wrote most of the scripts. Okay, so are you saying that the curriculum, the DMR, has not changed as a result of Steve's decision to do this retake? I'm concerned about getting confused with 2 different messages of training. Tom, the curriculum has been approved by Steve. He looks at the curriculum and we tell him what we're going to do and he says, okay, looks good. We talk about the curriculum, the presentation part of it, exactly like the way he does it. Okay? We throw in a little bit of our own experience. Okay? We look at it and we're like, okay, this is what we look at, this is how we're looking at stuff. We add in a couple of little nuances to it. Alright? If you like it, you listen to it. If you don't like it, you don't have to listen to it. But, you know, sometimes what we add to it might ring a bell. I know it did with a lot of people, with the M pattern, the filter we talked about. It helped a lot of people become very successful. All right, so the material is the same, just a couple of little nuances when we say, hey, this is what I like to look at, or this is what I like to do with it. That's it. It's the same material. Micah, thank you. Fractional disparity is a bit of a mystery still. I do have a piece of it, but I feel very weakened on this topic. Any plans for putting it in the curriculum? Steve, good question about fractional disparity. Personally, you need to be able to grab the M's and W's, clean M's and W's easily. Once you get that piece down, then you can start broadening your knowledge of it. All right, because when you have so much stuff, first of all, you're looking at M's and W's. I'll tell you the problem with fractional disparity with me personally. Again, I'm giving you my personal point of view. Obviously, if you ask Subio who has 30 years of experience, he's going to tell you something different. Okay? My point of view is, I used to get into a trade based on fractional disparity, which was awesome. I would look and say, okay, this is moving, that's holding, I'm going to take this trade, and used to move. Now, if I'm looking at EJ, for example, and Euro did a nice M, and I looked at Euro Yen, and I took the short. When I see dollar yen bouncing off a 200 moving average with 2 pins to the Mayo, in my mind, I'm like, oh, dollar yen's going the other direction, Euro is still dropping, probably very likely EJ is going to chop, or it's going to go into sideways consolidation, right? So I get out of my trade. And then guess what? Dollar yen bounces off the moving average and then holds at the 200 while Euro is still dropping. So EJ continues to drop. And that fractional disparity stuff starts messing with my head, and I used to get out of trades very quickly. So I figured, you know what, it's an advanced topic. Maybe in a future time we can add that into it. But as of right now, we're just going to hold off on that. Just, kind of focusing like Steve on the main topics, which is the anchor formation, trading away from the anchor, the market maker cycle. Okay? Manny's asking, what is my signature trade? Second legs of M's and W's. That is it. I only take second legs. Do I trade pushes? Yes, I do. But I only go in, if I trade a push, I'll go in with a smaller position. All right? Because I've homeworked this a ton, and I used to trade the pushes a while back. Some of the guys from the New York, New Jersey area knows me about trading the pushes. Bruce, please send me an email. Okay, for those who are interested in the DMR, it's FRACTAL, fractalpips, PIPS, @gmail.com. Okay, fractalpips@gmail.com. Robert, same thing, Robert. Just it's fractalpips@gmail.com. Welcome to the candy shop. Yeah, that's what it is. Do not move until they hit the stop or something like that, right? Yeah, that's funny. Oh yeah, don't enter till they hit the stops. There you go. This is a quote from Isubio. There is often a misinterpretation of the indicators. EMAs, for example, if they are close together, is because price is ranging, not the contrary. That is why it's not wise to trade at that place. Absolutely correct. All right, when the moving averages are all kind of bundled together very closely, price is kind of very choppy. It'll bounce back and forth, and you skip that. You don't take that trade. Okay. Please do a session on indicators and scripts. Okay, Christine, send an email to Steve. Let him know that what you guys need help on, and I'm sure he will try to work that in somewhere. All right. When there is a move in the Asian box, say 30 pips down, and then it comes out of the box and does a stop and high, do you start your count of the pushes from the stop and high, or is the first push in Asia? So wherever the second leg is, if that's my second leg, that's my push one. Doesn't matter where it is. All right, this is push one, and usually I like my push one to be out of the 1, 2, 3 pattern. So this is my 1, 2, 3, my M pattern. I want the level 1. I want this to break that 1, 2, 3 pattern, my pattern. All right, if it doesn't break my pattern, okay, if it doesn't break my pattern, it doesn't kind of work. It doesn't work too well. See, like that. Here's my pattern. I like it to break through it and break right down to it. All right. Oh, I see what you're saying, Tom. Yeah, we are week 8 and Steve is starting. Doesn't matter, Tom. I mean, it's he's only going to cover like a couple of weeks here and there. He's not, Steve's teaching is going to be sort of, we go into more into details on it. Steve is just kind of giving you the material the way he sees it, and we kind of give you a material a little bit with our own take on it. So homeworks and stuff like that. So, this is another Eusebio's thing. To be used efficiently, fractional disparity requires a shift paradigm. It requires to visualize what the individual currencies are doing instead of the pair. I suppose Steve has simplified the presentation on that subject for the sake of simplicity. That is absolutely true. Steve has not, if you went in Orlando, Steve has not spent a lot of time talking about fractional disparity, because he wants to make sure that you grab the second legs of the M's and W's. That's what he does. Okay, can he use a little bit more complex with the fractional disparity stuff? Yeah, he does, but all right, so I'm done. Hopefully you guys learned something today on pushes and how to trade the intraday levels of pushes. Again, find the anchor and look for 3 of those. I mean, 2 pushes, 3 pushes intraday, but just, you're trading push 1 and push 2. The third one is going to be a reversal, so be careful with that one. Okay? All right, this is last one. I get a solid colored box, and then I try to get lines. How do you just get the box lines on MT4? Okay. Oops, hold on, let me just get out of end show here. Okay, so if that is the case, right, here's the pushes that I was drawing on here on this account demo. So what you were saying is that how do you get this not to show a solid color? So if I'm here, when I draw this, it looks like this, by the way. It's like blue, like that. When I draw it, it looks like that, right? If you double click it, you get these little dots pop up. Right click, rectangle properties. Make sure the object is background, you click that, and you can change it to whatever color you want, and click OK, and it becomes a box. Alright, so hopefully that answers the question. Alright guys, I am done. Hopefully it was good stuff and you guys learned something new on how to trade. So when you come in and price is already pulled away from you, don't panic and be like, oh, I'm done for the day. You can be done, but if you understand and say, you know what, I'm just push 1 off the peak, I'm still going to trade away from it. That's it. You can still do it, and like this, be very accurate. It's great, good stuff like this. Trap moves, take these moves. They're great. All right, homework it first, guys. Homework it first.